Good afternoon and welcome to this webinar. It's organised jointly between Manchester Met University, Chartered Bankers Institute and ICAEW Northwest. This is the last one of 2021 and we're arranging the programme for 2022. The first event of the year is going to be on the 19th of January with more details to follow, so please watch this space. This session is being recorded and will be made available to you afterwards along with a copy of the presentation. Please feel free to put questions into the chat box and Niels will answer at the end of this presentation. Over to you, Stuart, so we can learn about all things crypto.
Wonderful. Thank you, Claire. Welcome to members of the Chartered Bank Institute, members of the ICAEW here in the Northwest, and many others. I'm Stuart Finity, and you can see I'm here at Manchester Metropolitan University, and I'm joined by some of our students, future chartered professionals, both accountants and bankers, I'm absolutely sure. So my role today is I'll be facilitating and I'll asking the questions to Niels. So the plan today is about 40 minutes, and then we'll have plenty of time for questions. So as Claire has just said, please pop your questions in the Q&A box and we'll be able to ask them at the end. So I'm going to hand over to Niels pretty quickly now because I don't want to steal his thunder. I'll introduce him as Niels Pedersen. It is my pleasure to introduce you, Niels, and I'll let you say more about who you are and what you do. Over to you, sir.
Thank you, Stuart. Hello, everyone, and welcome. As Stuart said, my name is Niels. I'm a senior lecturer here at MMU, and today I hope to help you learn a little bit about blockchain and demystify some of the jargon that you may have been exposed to. And the reason I have used a puzzle or the image thereof on the first slide is because learning about this stuff is a bit like a puzzle. So if you're able, you got to start by grasping individual pieces and then putting them together. And then eventually, you get an overview of the whole and you understand it better. So before we begin, let me tell you a bit about myself. I'm a chartered accountant, like many of you. I wrote about blockchain as part of my book. In fact, there's a chapter on it. But because I have a background in professional services, I try to understand all this stuff in a very non-technical, plain English way. And I hope to convey some of that understanding and knowledge to you today. As a starting point, I'd like us to do a quiz. So get ready, because I'd like to gauge what your prior knowledge may be. So I'm going to ask you a question. And there's going to be a poll launched. And I'd like you to tell me who you think invented Bitcoin. Now, I am going to make my guess, but please feel free and to make a guess if you don't know. Or if you happen to know, please tell me the right answer. Okay, I think we can close the poll, and I'd like to see the answers. Okay, so I don't know if you can see the screen, but 76% of you said Satoshi Nakamoto, which is almost correct. 10% said Rishi Sunak. Clearly, he wouldn't be chancellor if he'd invented Bitcoin. So I'm afraid that is not correct. And then we have 5% said Nick Szabo. He's actually an academic and a computer scientist from the US who's written many interesting essays about cryptography and technology. And it is rumored that or it is claimed that he invented Bitcoin, but he's always denied it. And the correct answer is, well, someone anonymous, because no one really knows who invented Bitcoin, whether it was one person or multiple people. The essay that gave birth to Bitcoin is credited to someone called Satoshi Nakamoto. No one actually knows who that is. And so, yeah, yes, so we see that there's a range of knowledge in the room. And no doubt, if you're new to Bitcoin and or blockchain, you might feel a bit like this poor chap here. What do all these terms mean? What's all this jargon about? What's an NFT? What does decentralized finance mean? What's a smart contract? And what I hope to do today is to help you get over some of those initial stumbling blocks, and to give you a foundation of knowledge so that in the future you'll be able to go under the bonnet and deepen your own knowledge independently. Now, I think a good place to start is to make a mind map so we can get a conceptual overview of all these terms. And as you can see, as Bitcoin and blockchain were invented at the same time, so the essay written by Satoshi Nakamoto was an essay that invented Bitcoin, but in doing so, they also invented blockchain, because all Bitcoin is it's blockchain technology applied as a currency system. So Bitcoin is a currency system, and therefore it's a subset of blockchain technology. Now, that technology, blockchain and Bitcoin, rely on cryptography, which is why Bitcoin can also be labeled a cryptocurrency. So of which you may have heard, there are several hundred, and all of them, to a lesser or greater degree, are copies or have been inspired by Bitcoin. Now, when we use blockchain technology for non-currency purposes, we can call it decentralized finance, so DeFi, or indeed non-fungible tokens, NFTs. So really the key point to take away here, and we'll explore these terms a little later, is that DeFi and NFTs are just other ways of using blockchain technology that don't strictly have anything to do with a currency system. And then, of course, out here on the right, we have smart contracts. And you'll notice that the line is checkered. That's because though smart contracts have been popularized in the context of blockchain, they are actually a separate technology or invention. But when used together with blockchain, they can be an enabling technology. Now, what I want to do as we go through is I want to start with the most important thing to take away today, and it's this. A digital transaction, all it ever is a transfer of information. In other words, an accounting entry. And this is true in emails. It is true when you transact with a debit card, and it is extreme. It is more true than ever with blockchain technology, and indeed also in banking. So here you have a simplified model or graphic of how what goes on behind the scenes when you send someone money. So in this very simple example, when I digitally send money to another person's account, all that really happens is that I instruct my bank to reduce my balance, in other words, update information, and via my own bank, instruct the recipient's bank to update information in the recipient's bank account. And so what you could say is, well, this is, I am transferring information to the receiver, and all the banks do as intermediaries is keep score. And in some ways, this transfer of information is quite similar to sending an email. And in the context of Bitcoin, and more generally blockchain tokens, it's very, very similar. So when we send an email, we use our password to get into our inbox in order to send an email, in other words, information to someone else's address. When we transact via Bitcoin, we use a private key to authenticate transactions from our digital wallet that sends that token to someone else's address on the blockchain. So as a process, transacting or conveying information via email or blockchain are very, very similar. But it's more than a convenient metaphor, because a lot of the underlying cryptography is actually very similar, if not the same. Now, there is a key difference, and this is really the most important thing, that whereas I can hit reply all, or indeed send the same email to multiple people at the same point in time, when I transact in Bitcoin, and more generally blockchain tokens, I can only ever send that token to one person at one point in time. So if you like, sending Bitcoin is a bit like forwarding an email that you've already received from someone else and hitting forward and sending it onwards to one person. Now, the reason that I can only send that Bitcoin or blockchain token to someone else is quite simple. It relies on what is called a digital signature. A digital signature is essentially my stamp of approval that authenticates the Bitcoin transaction. Now, to generate that digital signature, I need two things: my own private key, in other words, my own password, and crucially, the digital signature of the person who sent that Bitcoin to me, so the prior owner. And that makes every new transaction consistent with every prior transaction. And that itself is a very strong security mechanism. Now, because we share our, because we're able to authenticate transactions securely by using digital signatures, that means we can actually share our transactions freely with the network for everyone to see. And that makes the Bitcoin ecosystem, it makes it very similar to the land registry, in that on a micro level, your claim to a plot of land relies on a land deed, which has the details and names, and if not, seals and signatures of all previous owners. So you prove your claim to the land by proving the provenance of the ownership of that land. And also, in most cases, the land registry tells you who owns what, subject to various privacy regulations and whatnot. But generally speaking, like it's you can see who owns what, who takes, who transacts with who. And so if you like, a blockchain system is in a way very similar to the land registry. But there's one key difference. Whereas the land registry is centralized, it's one institution, a blockchain network is decentralized. What that means is a copy of the transaction history is maintained at many different locations. So in the context of most blockchain systems, many different computers around the world. And though the specifics vary across different blockchain networks, such as Bitcoin, Ethereum, Ripple, and whatnot, of how this happens. Generally speaking, regardless of the blockchain system, all the different participating computers are incentivized financially to log and verify and store transactions truthfully. And in the context, it's a subject of a whole different talk how this happens, but very quickly, in the context of Bitcoin, this incentivization comes in form of newly minted Bitcoins. But anyway, what this means, this decentralization means, is that the network is extraordinarily robust, because just like you know, the peer-to-peer file sharing networks that some of you may be familiar with, such as Kazaa, Morpheus, Napster, and whatnot. Once you put the file, so the transaction history, in different locations, all you need is for one or very few other computers to run properly, i.e. to be online for the system to work. And that makes it extraordinarily robust, because there is no central point of control or central point of failure. Now, you might say this is somewhat of a contrast to our current model of banking, whereby we have different institutions with different ledgers that, when taken together, represent everyone's transactions and the complete history of transactions in the financial system. In a blockchain system, you have this transaction history in one place, in one file, and that file is copied and stored in multiple locations. And that's why you might sometimes have heard blockchain technology referred to as distributed ledger technology. So what does all this mean? Well, as a summary, if we are able to authenticate transactions securely with our private keys that we then use to generate transaction signatures as stamps of approval, then we can freely share our transactions. Because record keeping is decentralized, and power and control over the network is by virtue of economics, so the incentives of the system, if that power and control is decentralized, it means we trust the incentives and the rules and the code of the system as opposed to any individual or institution. So that, along with the transparency of the system, means that no one can claim to be party to a transaction that they have not been party to. So when I send you Bitcoin, I can see that you've received it on the network, and equally, you can see that I have sent it. So that reduces the need for intermediation. So in our current systems, some of you may be auditors, and a very common way of proving that a transaction has taken place when you're doing an audit is of course looking at a bank statement. Well, in this system, we don't need bank statements. We don't need to rely on banks as intermediaries because we don't trust each other, right? We trust our own banks because we have they have a commercial relationship with us, but we don't necessarily trust each other. Well, in blockchain systems, we trust the structure and incentives and cryptography of the system. And that allows us to transact digitally as if we were transacting face-to-face via cash. Now, how will this affect financial services? Well, to answer that question, I want to take you back to, again, the most important slide. And that is that, well, if we accept that a digital transaction is no more than an information update, but well, that gives us the key to understanding how financial services can potentially be affected by blockchain technology. Now, to start that conversation, let's look at the smart contracts, which are an enabling technology of this disruption when used in conjunction with blockchain technology. So what is a smart contract? It is a piece of computer code, in other words, a computer program, that automatically executes the terms of a contract when the contractual provisions have been satisfied. So a very good example of that is a vending machine, because the requirements of the contract are clear. Enter, well, let's say £1.50 or whatever the price is these days, and get a can of Coke, right? It's clear. And once you actually enter whatever the cost is, you get a can back, and indeed your change. So a vending machine is a very rudimentary but very clear example of a smart contract. Now, I don't need to tell you that vending machines were invented far in advance of Bitcoin, but essentially, because blockchains are decentralized, because the participants in those systems trust the incentives and structures and security mechanisms of those systems, combining smart contracts with blockchains essentially allows people to interact under contractual terms in a way that doesn't require intermediaries, and therefore this reduces transaction costs. And this has clear implications for financial services, and essentially this is what is referred to as decentralized finance, because whilst when we use a cryptocurrency like blockchain, we transfer tokens, which are really just information updates as transfers of value. If we bend the rules of what a transaction means and say, well, a transaction is just an information flow, well, then we can drastically widen the scope of potential uses of blockchain. And as you can see, I've listed a few ideas here, but it's essentially financial subsectors where there's a lack of transparency, where there's a lot of paperwork and over-reliance on expensive professional time. Now, as blockchain technology combined with smart contracts reduces the need for intermediaries, this puts downward pressure on transaction costs. And what this means is that blockchain technology allows people to transact in ever smaller transactions. So in other words, things like microloans or micropayments become possible. And what's more, because of the digital nature of blockchain technology, we're no longer, constrained by geography, and so that is what makes decentralized finance very exciting. Of course, we can also use this technology for non-financial services or non-financial purposes. And one good example of this is what is called a non-fungible token. So, known short as NFT. Now, to understand what these things are, let's explore the concept of fungibility. Fungibility means that something is interchangeable or just as good as something else. So, for example, an ounce of pure gold is just as good as another ounce of pure gold, right? That there is no difference in the value of that, or indeed how anyone would transact in it. Now, a Bitcoin is just as good as another Bitcoin. And that's because if you offer to send someone a Bitcoin, they don't care where it comes from, right? They couldn't care less as long as they receive their Bitcoin. And however, there's a difference between ounces of pure gold and Bitcoins in that because all Bitcoin transactions are linked via digital signatures to all transactions before that have come before, actually, even though the users of Bitcoin don't care whether one Bitcoin is different to another, all Bitcoins are unique and you can trace their provenance. And this means that, well, okay, so if we're transacting and we're just transferring digital information, why not use blockchains to make digital artworks scarce? Because an image that is digital can be easily copied, by printing the screen or downloading the image from the website. And so there is no scarcity. Well, if you can use a blockchain to track the provenance of a file, whether it's a video file, a music file, or indeed a JPEG, then all of a sudden you can make digital artwork scarce. So that's what non-fungible tokens attempt to do. And if you think about it, it's a bit like when you make a print. A painter makes a print. They destroy the printing plates to ensure the scarcity of those prints. In other words, to make them scarce. And that's what you do with an NFT. So if you like, a very oversimplified and rudimentary explanation would be, if you are a photographer, you take a unique image and you have that file and you upload that file into an email inbox, and then you go and sell the password to an art collector so they can gain access to that digital file. That is essentially what happens underneath the bonnet when people transact in NFTs. So that's an interesting application of blockchain technology. Indeed, one that may have transformed the art world. Now, of course, that's just one example, and I gave you a few today. Earlier on the list, there was a bit of loan syndication, reinsurance, things like that. But essentially, to conclude, to look forward, we want to know, well, what can blockchain disrupt? And I would say, well, anything that can be done behind the scenes, away from end users. So in other words, back office stuff. Anything that requires more transparency, that is heavy in paperwork, and where there's a need to track the provenance of information flows, that's where we can use blockchain. And where will financial institutions try to start applying blockchain? Well, anywhere they can reduce transaction costs. And unfortunately, for many of us, that means where there's a reliance on expensive professional time. And that is it. I will now move on to taking questions. It went a little faster than I had anticipated, so hopefully there are many questions. Feel free to reach out to me on LinkedIn if you want to ask any further questions or comment on what I've said if you don't get to do it now. And I will pass it over to Stuart.
Wonderful. Thank you, Niels. There are indeed some questions coming in, and I've got some from the room that I'm in right now. Just first of all, there's a question, and again, everyone, please feel free to put your questions either in the Q&A box, ideally, or in the chat box. I'll happily pick those up. But the first question I've had from the room here is we've got some students that are already investing in cryptocurrencies. What do you see as the risks and benefits of doing that? And without giving advice, can you give any guidance?
Well, so I think this is a controversial space because there's a lot of hype on the internet, and the debates can be quite tribalistic. What I would say is you should look at criticisms of the crypto space, because if you think about what a crypto is, when you think, oh, I buy Bitcoin, well, no, when you buy a Bitcoin, you're buying the right to convey information to someone else. So that's all it is. There's nothing tangible there. The other thing is, from an investment perspective, I've read that some institutions try to invest in crypto for diversification. Well, I have bad news for them. Unfortunately, cryptocurrency prices correlate very closely during market downturns with stock market prices, and that's because people trade, U.S. tech stocks with leverage, and when the prices of those go out, they have to close their other positions, some of which will be Bitcoins. And then finally, my final thought on it is, there are people who make money doing it, but they look at it as if it was a poker game. Investing in cryptocurrencies is like trading forex. It's a zero-sum game, and you have to be able to look at what is going on, where's the money going, what is being hyped. So it's very like the people who are successful at this, they treat it as if they're trading, let's say, commodities is probably the best analogy. No one buys a barrel of oil to hold it forever, and that's what the successful crypto investors do. So that's my answer. Very long answer to that complicated question. To be fair, it's a hotly debated topic.
So I'm just looking back into the room, and I can see some of the investors here actually keeping their heads down now. I think what you've highlighted is some of the risks that I've highlighted. Certainly, it's on a speculative end. So thank you for that. So a really interesting question here, and it's just disappeared as loads of questions are coming in. So thank you for these. The question is, what is Bitcoin? And I'm trying to get up this page. There we go. I've got there. A question from, I think it's Clem. I can't see the full name, but what is the meaning of Bitcoin? Is it simply money or software? And they've been trying to understand it for a real long time. So can you help?
Yes. I mean, with not to be too shameless, but I would recommend reading chapter 5 of my book. But basically, in very simple terms, the shorthand explanation is money via email. The slightly longer explanation is that Bitcoin is a currency system that is decentralized, like a peer-to-peer file sharing network. And so it's closer to an accounting system than it is to a payment system, or indeed a monetary system.
Wonderful. Hopefully that's helped. Feel free to ask another question if you want any clarity of that. Lots more questions coming in. A question from Damien Webb. Do you think reading the white paper for any crypto prior to investment will be valuable? And a sort of follow-up to that, do you suggest day trading is more appropriate rather than long-term investing?
Oh, well, so two things first. I think white papers are always interesting to read because you learn a lot about cryptography and mathematics and things like that. And whenever you take financial risk, one should always do one's homework. In terms of trading, I can't really comment on that in a public forum. I would say that there is a distinction between like trading and investing, and there are different approaches. And if you read books about that kind of sphere, you know, the one book, I can't remember the name of the author. I think it's Jack Swager, Market Wizards. That book is full of case histories of people who invest and trade in different ways and in different asset classes. And the kind of upshot there is people do it differently, and they do it according to their own skills, experience, but most crucially, their own temperament and risk appetite. So I don't think there is, you know, a be all and end all for everyone. I hope that answers the question.
Wonderful, diplomatically put, I think there, Niels. Thank you for that. And it's quite a long question here from Sunny, and highlighting China destroying a lot of Bitcoin digging factories in Mongolia. But I think there's other examples of government intervention around the world in the markets.
Yeah.
What do you think the impact of that is going to be on the value of Bitcoins and other cryptocurrencies?
That's difficult to say, because, you know, let's not forget there's such a thing as the I think it's called the Streisand effect. When you ban something, people become more interested in it. But in terms of rules and regulations, the general trend is that the biggest risk by far to regulators and governments is that cryptos are used for money laundering, which they happen to be. And so the impetus globally has been for regulators and policymakers to regulate the interfaces between the crypto markets and the conventional financial system. That said, I don't think that'll work, unfortunately. It'll make money laundering more costly and more difficult. And the reason I don't think it will work is that, strictly speaking, to interact with a decentralized network, if you are reasonably good at you know, software development and coding, you don't need a digital wallet in order to engage with the network. And then and what's more, there is such a thing as a decentralized exchange, where you don't know your counterparties, and that kind of technology is already there, and the cat is out of the bag. So it's truly, like, in terms of regulation with Bitcoin and crypto, I think that there's only so much policymakers can actually do, and I think part of you know, addressing the risks, whether that's tax avoidance, money laundering, frauds, and scams, actually should be addressed more holistically. So for example, when you're dealing with money laundering, you're really dealing with organized crime. When you're dealing with scams, you're really dealing with a lack of financial education in the general population. And I think that's one of the things we, as a society, we need to realize, that if you want to minimize the risks of you know, blockchain and crypto and things like that, or the deleterious effects that might be imposed on society, we have to look at the big picture. I hope that the long answer answers your question.
No, I think an accountant's answer that, weighing up the costs and benefits there.
Yeah.
I think your training comes through. There's a linked question here, maybe from the other side of things, about what benefit could this technology have to the Bank of England? And I think that must be after some press speculation about them launching their own coin.
Well, that is interesting, because we have to take a step back and think about what, you know, the money in your wallet is, pound sterling. That is already digital. Yes, you have it by paper, and you have it. You can also transact digitally, and so I see a central bank digital currency it'll still be pound sterling. And yeah, okay, so you can transact with it via a digital wallet. Okay, that'll remove the need for some of the banking infrastructure. So that potentially makes transaction costs in the system lower. But for us in the UK, we don't really have overt transaction costs imposed on our transactions when we transact via banks digitally. So I don't think to the end consumer anything will change that much, other than maybe they might have a portal online where they can log in and send money as if they were sending email. From a market's perspective, again, whether it's pound sterling on a blockchain or in a coin, the value is the same. So I don't really see a reason for any kind of hype regarding value fluctuations. So all in all, it's an infrastructure change more than anything else, and perhaps a marketing exercise. So sorry if that is a disappointing answer.
So it makes it sound far more routine than it does from the hype, but
yeah,
maybe a bit of calm reflection is useful, Niels. A series of really interesting questions from Alex. Alex is pointing out that a lot is made about the decentralized nature of Bitcoin, and you mentioned that yourself, Niels. But he's also pointed out that most of the trading is handled in quite a centralized way. And he's interested in what would it take for this to change. And then as a bit of a follow-up, is Bitcoin or blockchain technology more a way to cut out intermediaries, or is it a way for individuals to cut out the system overall? So almost two groups of questions there, Niels.
Well, let's start with the intermediation. Strictly speaking, whilst it's technically possible to transact peer-to-peer from one computer to another without any intermediaries on this network, you still have to have a user interface, so an app that allows different people to connect, right? But an interface is not the same as a financial intermediary. So it's a bit like the difference between a bank and a peer-to-peer lender. The bank will put assets and liabilities that pertain to borrowers and lenders on its balance sheet, whereas a peer-to-peer lender should not normally do that. They just facilitate the connection. So I think in terms of disintermediation, I think blockchain facilitates more of that, but we still need institutions that act as interfaces. Now, what was the other question again? The more difficult one?
Was around I guess the centralization of the exchanges.
Well, I don't. If you look at liquidity, yes, some of them have more liquidity than others, but there are many, many, many venues where you can trade crypto across the world. And yeah, okay, some of them are more liquid than others, and yeah, some of them transact in larger lots. But if you're not trading a lot, I would challenge that, because if you compare it to the number of stock markets or stock exchanges, there aren't very many. So for example, here in the UK, we have 3. The FTSE, the AIM, and I think it's still called the Plus or whatever it's called. But they're like, that the crypto sphere, even though the liquidity may be concentrated in certain large exchanges, the ability to transact and trade crypto is not. Okay. Unlike conventional stock markets.
Okay, no, that's interesting. And a shorter but quite an interesting controversial question here from Anthony. It says, since blockchain is so transparent, how is it so preferred for ransomware payments?
Well, because you're just a number on a blockchain. So you don't actually need to give your name or your date of birth. It's just computers transacting with each other. That said, some systems are more anonymous than others. So because there's a transaction history, and the history of transactions of Bitcoin, for example, is up there for all to see, you can actually data mine that, and regulators and law enforcement do, because just because you're anonymous, that doesn't mean you don't exhibit patterns. And if you interact with digital wallets, your IP might be logged. So certain systems aren't as anonymous as people think. That said, there are other systems that actually that don't show the transactions on a network. So when you transact via a private key, you just need a confirmation that it's been received. So in other words, you just need that stamp of approval at both ends of the transaction. And I believe the Monero network works on that premise. And the fact that the transactions aren't visible to the whole network makes it much more difficult to track patterns of transactions. So yeah, different types of criminals of different levels of sophistication use cryptocurrencies in different ways. And the ransomware ones, by the very fact that you are a hacker, you should know this, and 10 times more, if not 100 times more. So those are the more sophisticated bad actors in that space.
Well, I guess as ever, it's going to be a race between the forces trying to prevent fraud and the criminals trying to perpetrate it. And we see that in conventional banking as much as we do in crypto, I guess.
Absolutely. It's in fact, you could term that a competitive game, whereby the criminals are simply bad entrepreneurs, whereas a good entrepreneur looks for gaps in the market to exploit. Criminals simply look for gaps in security systems and whatnot to take advantage of. And so if you see it as an information competition, much like a financial market, is a race to exploit information before everyone else does. But well, that might give you a different perspective on things like anti-fraud or anti-money laundering or risk management in financial services.
No, absolutely. And a question here from Selen, particularly interesting after the COP26. There's all these computers verifying things, but what are the implications of sustainability on crypto? Because some of the carbon footprint is particularly high.
That is true, which is why we have several different, or many different cryptocurrencies. So in crypto, there are different ways of, shall we say, arranging the incentives of the system such that the participating computers have more to gain from the system than attacking it. And in the context of Bitcoin, I alluded to this earlier, that incentivization takes the form of freshly minted Bitcoins. Now, the reason that is there is, well, A, to maintain the integrity of the system, and B, to reconcile the ledger. Now, because all the different computers are logging and verifying transactions in different parts of the network, and so that incentive structure serves those two purposes: to maintain the integrity of the network and to reconcile the ledger. And all blockchains face that problem, and there are different approaches. Now, the main criticism of Bitcoin is it's very carbon intensive because it's purely incentives based. And the reason they call Bitcoin, the participating computers, they're referred to as miners, is the fact that they spend all this energy to get to freshly minted Bitcoins, just like gold miners spend a lot of energy to dig gold out of the ground. So in other words, they don't get this new money, if you like, for free. Now there are other ways of doing this. For example, Ethereum uses a what is called a proof of stake mechanism, whereby, again, the objective is still aligning the incentive structures so that the participants have more to gain from supporting the network than trying to cheat it. And the way they do it is you essentially get more say in how the ledger is reconciled, and you get more freshly minted tokens if you buy the Ethereum token and invest it in the network. So in other words, you demonstrate that you have more of a financial interest in the healthy existence of the network. So that's another way of doing it. And these are interesting approaches to decentralized and completely open source systems. But perhaps the least energy intensive one that exists is a purely trust-based system. So for example, now we're using Zoom. So by implication, we trust Zoom, right? We use Outlook. So by implication, we trust Microsoft. And so we do in the blockchain space, we do have these enterprise level blockchain networks that are decentralized. So they're often run by consortium of financial institutions, banks and tech companies, and indeed academic institutions. And they're run almost purely on trust, because there's no reason for, let's say, MIT not to trust Google, not to trust Microsoft, especially if they are working together and they have a financial interest in this system that they can then roll out for everyone to use and make money from it. So that's perhaps the least energy intensive way of doing it, because the logging and verifying transactions and reconciling the ledger when everyone trusts one another is computationally very, very easy. Which is why, by the way, if you compare the transaction throughput of Bitcoin, which is somewhere in the region of 7 or 8 transactions per second, to that of something like Ripple, which claims, I think the last I read was 1,500 or 3,000 per second. That's an efficiency jump by several orders of magnitude. But still nowhere the Visa network, which can support at least 30,000 transactions per second.
So you're almost saying that the less distributed networks, the less distributed models are probably the ones with more capacity and are more environmentally friendly. Would that be fair to say?
Yeah, but let's not forget, we also have to measure, if we're going to go from Bitcoin to Ripple to Visa, we also have to measure the carbon footprint of the Visa Corporation and its associated entities to make a fair comparison. But I'm sure that Visa does not consume as much energy as a small country like Ireland or Switzerland or Denmark, which are the countries you throw around when people say, oh, Bitcoin consumes X amount of energy. I think the truth is no one really has an exact figure, but even if you consume a lot, as much as Switzerland, then your carbon footprint isn't great.
It makes a change from measuring everything in terms of Wales. Interesting question. A few questions coming in, which are a little bit in terms of Manchester and what are we doing. One, and I don't know if it's one of the students behind me who's asked this, or one asking, is it really interesting topics? Are we covering these topics in university courses at the moment?
Yeah, well, we have a postgraduate degree here at MMU, which is an MSc in financial technology. that I teach on, and I cover this topic in quite some depth as part of my Innovations in Technology module.
Brill. So we've sold the course as well as selling your book, which is always good.
Thank you.
More maybe in selling Manchester itself, a question from Ed here about how well does Manchester stack up as an international base to run and start a blockchain company, and what's the best way to start businesses in and around Manchester?
Well, I think Manchester is great for several reasons. It's smaller than London, so everyone knows one another, and so it's very easy to network and get people to talk to one another. So some of my students will know that we had the CEO of a bank come in and speak to us that was based in Manchester. And, you know, good luck trying to get that done in London. The other thing is, you know, there's a lot of good office space in Manchester. There are lots of good networking opportunities, and rent is cheaper. So those are the benefits of being in Manchester. Though some of the problems are that there's not as much many coders here as you would find in London, and you need that if you're running a tech startup. That said, I know people who do run tech startups, so they must find a way to make it work. So that would be my 2 cents on the tech scene in Manchester.
There we go. From Manchester's point of view, it's also one of the biggest cities in terms of investment into payments as well. Is that right?
Yes.
Well, in fact, you're getting some love from some of your students here that seem to be messaging in about covering some of the material on MBA courses. So you've got a fan club out there, Niels.
Oh.
And I guess just into our final questions, somebody's commented that NFT is more a result of inflation panic for investors, and the value of the products are really hard to measure. And I was just saying that it's just a comment. Have you got any comments on that?
Yeah, well, actually, as it happens, I discussed this topic with a friend of mine who is a professional artist who does galleries in big, big cities, Paris, New York, and whatnot. So really, someone who's on the art scene, and he said, well, you may buy an NFT for like whatever, but the problem you always have with art is what is called the greater fool theory. Any piece of artwork you buy for speculation, the next problem you have in the future is convincing someone else that it's worth more than you paid for it. And he said that's the problem with NFTs is that, yeah, people might, buy something and love it, but that doesn't mean, even though it looks good and it's nice art, that doesn't mean that its value will appreciate.
Okay, I think a challenge on people being cautious about value appreciating indefinitely is maybe quite a nice way to end, Niels. So I just want to say thank you very much for sharing the information today. As other people and you are certainly aware, we run a series of these events. Our next ones will be in January. I just want to say thank you to the Chartered Bank Institute for hosting the technology today. Thank you to Claire and everyone at the ICAEW. And thank you to students and other people involved here at Manchester Metropolitan University. If anyone has missed it, we will put a recording out. And Damien's also just put a message out plugging your book as well, which is a nice way to end.
Thank you, Damien. And thank you for all the questions. If anyone wants to get in touch, just find me on LinkedIn.
Perfect. Thank you very much.
All
Take
right.
care.
Bye-bye.
Bye.